Top stocks are what we're after, and in the midst of market uncertainty, rising interest rates, high global inflation, and geopolitical crisis, it's best to position our portfolios well to weather the impact of an impending recession all these may bring. We do tons of research about the stock market, and our goal is to help you on your journey to financial freedom so you can live life on your own terms. That being said, we're here to bring you the 5 top stocks to buy right now. If you like this video, make sure to destroy the like and subscribe buttons so that you won't miss any of our future content. Make sure to stay till the end as our last stock pick is our favorite and we think you'll like it too. Now let's get right into the video. First off, we have Walmart Inc., WMT. Walmart Inc. is the largest retail chain in the world and it runs 6,101 overseas locations, the majority of which are in Latin America, along with 3,570 supercenters, including food departments, 374 discount stores, 599 Sam's Clubs, and 799 neighborhood markets in the United States as of January 31st, 2022. 1.121 billion square feet are allotted for retail space. Most retailers are 400 miles or less from a distribution center, and most retail space is privately held. 56% of American sales were made up of groceries. In 2021, sales per square foot were roughly $500. Walmart's stock sharply dropped 18% from its peak of $127 a share to around $104 a share during the March 2020 crash and quickly recovered as investors began to realize that the retailer benefits most from the panic buying that was happening back then. Its current price is sitting near its all-time high and is consolidating while the overall market awaits a trend reversal. Walmart experienced strong revenue growth across all international categories in the third quarter. As a result of Q3's outstanding results, the retail juggernaut increased its full-year target for consolidated sales growth by 1%, currently anticipating an increase of about 5.5%. Despite exceeding projections and seeing robust sales growth, Walmart reported a $1.8 billion net loss for the third quarter. Let's look at the business's performance and see why the consumer staples stock is still a hold. Despite reporting a $1.8 billion loss compared to a $3.1 billion profit last year, CEO Doug McMillon said Q3 was a good quarter because of the increase in sales. McMillon is still confident in Walmart's capacity to meet members' and consumers' needs on a global scale. Indeed, according to Walmart, the company is experiencing growth in all areas of the business, including online sales, Sam's Club locations, and physical shops all over the world. Online sales are rising. They increased 16% between the second and third quarter of this year alone, accounting for 13% of Walmart's sales thus far in 2022. E-commerce increased 46% year over year when looking at it from a constant currency perspective, which removes the impact of currency exchange rates on sales data. Walmart aspires to return to profitability in the future by enhancing both its inventory and supply chain. Improved vendor sales agreements are one method for doing this in order to cut expenses and lessen the impact of inflation. Looking into Walmart's historical revenue, it booked an average of $507 billion over the past decade, from $470 billion in 2012 to a whopping $573 billion in 2021. Although its operating margin has tightened from 7.7% to 6.4% from 2012 to 2021, its return on invested capital has grown from 15.3% to 15.6%, with an average of 13.5% annually over the same period. Our model suggests that Walmart still has room for more growth, and our model conservatively estimates 12.5% annual returns over the next 5 years. Next, we have a company called Ryder System, Inc. Ryder System, Inc. provides full-service transportation solutions, commercial vehicle rental, scheduled maintenance, and truck leasing with over 523 operating locations, integrated supply chain logistics across all of North America, Canada, Europe, and Latin America. Ryder oversees a fleet of more than 500,000 automobiles and more than 68 million square feet of organized warehouse space. Its stock price has been trending downwards from 2018 through the end of 2019, and the global market crash brought by COVID has certainly sent the stock spiraling downwards to a low of $23. But out of all the global stocks that were hammered by the 2020 crash, Ryder has been one of the companies that has not only recovered back to its 2017 peak, but has remained there even during the duration of the current bear market. Since our May assessment, Ryder System shares have increased in value by 7%. Its stock price is currently 29% higher than the 52-week low it reached in April. These are optimistic indicators that the trucking industry as a whole and the larger economic outlook have both modestly improved and maintained solid momentum. H.G. Vora Capital Management, a New York-based private equity firm, made an unsolicited bid to purchase all of the outstanding shares of Ryder that it does not already own for $86 per share here. According to what we know, the board is still considering the bid, but there has been no sign that it has already been approved. Investors also seem to bank on a softer landing for the American economy and strong consumer spending to support margins even as post-pandemic demand starts to slow down. The company is operating at peak efficiency in terms of performance. In the June quarter, the firm reported earnings of $4.43 per share on revenues of almost $3 billion. Thanks to higher volumes and pricing than anticipated, this performance far exceeded consensus expectations. Pent-up demand in the freight markets has helped the freight mover perform better recently, and the multi-year lease pricing program that Ryder started executing in 2019 has been very successful so far. Ryder's revenue has consistently grown in the past 10 years, with an average revenue of $7.5 billion per year. Operating margin has been consistent at an average of 24.2%, and return on capital invested averaged at a pace of 4.8% annually. Our model suggests that Ryder is still poised to grow at least 13.8% in the next 5 years, given its current momentum. Next up, we have Oracle Corp. Oracle Corporation is the largest supplier of database management system software and the second largest independent software and services company in the world. The company's primary business activities include the development and marketing of a family of software products for financial, human resource, and manufacturing applications, as well as an integrated line of computer software products used for database management, computer-aided systems engineering, applications development, and decision support. Oracle sells its goods as well as related consulting, training, support, and systems integration services through its subsidiaries in more than 140 nations. Prior to the March 2020 COVID crash, Oracle's stock price has been trading at around $55 a share. This sharply dropped to $40 a share due to the global market turmoil. The stock recovered quickly from this level as the US Fed pumped cash into the economy, and Oracle was positioned well enough to benefit from this capital inflow. The stock rose 164% from its March 2020 low to $106 a share by the end of 2021. Even in the midst of the current market downturn, the stock is still trading above its pre-COVID levels. It is an incredible accomplishment, especially in light of the setting and background of economic instability and recession headwinds, that Oracle Corporation announced its 2023 Q2 results, stating that revenues were up 18% year over year in USD and up 25% in constant currency to $12.3 billion. Oracle's most recent acquisition of Cerner was a sizable source of sustained profit as it contributed $1.5 billion to the entire sales. Cerner is a leading electronic health records company with a wide variety of offerings and services in the healthcare management and data space. Oracle acquired Cerner for close to $28 billion late last year, a price that was simultaneously hailed and carefully praised. Larry Ellison, the co-founder of Oracle, was clear about his goals for the acquisition, saying that Cerner and Oracle have the capacity to transform healthcare delivery by providing medical professionals with better information, enabling them to make better treatment decisions, resulting in better patient outcomes. Looking into Oracle's numbers, its revenue has fared well over the past decade, from $37 billion in 2013 to $42 billion in 2022. That's an average of $39 billion in just 10 years. What's more, its operating margin has averaged 35.8% from 38.8% in 2013 to 26.2% in 2022. Its return on invested capital averaged 11.7% from 17.6% to 8.4% over the same period. At its present share price of $64 a share and conservative earnings per share predictions of 8% annually, our model projects that Oracle's stock will have annual returns of 14.4% over the next 5 years. Coming up next is Nike Inc. Nike Inc. is an American multinational corporation that creates, develops, produces, markets, and sells clothing, accessories, equipment, and services on a global scale. The company's global headquarters are located in the Portland metro area, close to Beaverton, Oregon. It is a major producer of sporting goods and among the biggest providers of athletic footwear and gear worldwide. It has more than 44,000 employees worldwide, and in 2014, the brand alone was valued at $19 billion, making it the most valuable brand among sports businesses. Nike Inc. was founded by Bill Bowerman and Phil Knight as Blue Ribbon Sports on January 25, 1964. On May 30, 1971, the company changed its name to Nike Inc. The business was given the name Nike in honor of the Greek goddess of triumph. Nike stock was trading at around $102 a share before COVID hit. When the lockdowns were announced, its stock sharply fell to $60 a share, a 42% drawdown from its previous peak. Despite the headwinds that followed, Nike's stock recovered well above its pre-pandemic lows in just 5 months. If you've perfectly timed the market and bought Nike in March of 2020, you'd be sitting at around 90% profit even in the midst of today's market downturn. UBS, a multinational investment bank and financial services company founded and based in Switzerland, has reported its 3 stock picks with highest conviction for 2023. Among these are AMD, Zillow, and Nike. We've focused on stocks where we believe our analysts have a differentiated view versus consensus, and where we have an interesting or proprietary data source. UBS strategist Keith Parker wrote in a note to clients highlighting the top picks. The names on UBS's list represent the highest conviction calls, the note stated. In tabbing Nike, a UBS analyst wrote of the company's potential to grow at a high single-digit or low double-digit annual rate on the back of drivers like market share gains and mix shifts in buying channels. We believe the market doesn't fully appreciate how Nike's investments in product innovation, supply chain, and e-commerce are working in concert to drive unit growth and ASP increases, Sol wrote, referring to the average selling price. While the athleisure trend might be changing, he still sees growth in the industry and views Nike as well-positioned to capitalize on its evolution. Athleisure is still about comfortable and casual attire, but is moving away from performance to more streetwear styles, he wrote. Fortunately for Nike, sneakers are at the center of streetwear culture, and consumers accept it as a streetwear brand. Looking into the numbers, Nike's revenue has risen from $25 billion in 2013 to $47 billion in 2022. That's an average of $35 billion of revenue per year. Its operating margin has increased from 12.8% to 14.3%, averaging 13% over the same period. Our favorite part is its return on invested capital. From 21.3% in 2013 to 25.8% in 2022. That's an average of 24.7% over the past decade. At its present share price of $87 a share and conservative earnings per share predictions of 12% annually, our model projects that Nike stock will have annual returns of 14.7% over the next 5 years. Last but definitely not least is our favorite stock for today's top picks, Domino's Pizza, Inc. Domino's Pizza, Inc., or Domino's, is a pizza restaurant chain. Through its restaurants, it offers dine-in, carry-out, and delivery options for pizza. Pizzas of all shapes and sizes, pasta-based dishes, chicken wings, boneless chicken, oven-baked sandwiches, bread side dishes, soft drinks, and desserts are all available to Domino's customers. Additionally, it offers a variety of toppings based on region and culture. The company operates through a network of company-owned and franchise stores across the US and in international markets including India, the UK, Mexico, Australia, Turkey, Japan, South Korea, Canada, France, China, Germany, and others. The U.S. city of Ann Arbor, Michigan is where Domino's is headquartered. Prior to the COVID crash of 2020, Domino's stock was trading at around $375 a share. This briefly plummeted down to $277, a 27% drawdown from its peak due to market fears, yet this quickly bounced back as investors began to realize that Domino's Pizza was positioned well to reap the benefits of food deliveries while the world is on lockdown. Its price reached new heights to around $560 a share, yet has tumbled back due to the current macro climate, which we believe is a perfect time to accumulate the stock at a bargain. According to Domino's senior business executives, Domino's Pizza Inc. will considerably expand its retail shop network in India as it wagers on increased demand for its goods in its largest market outside of the US by store count. As part of the strategy, Jubilant Foodworks Ltd., the Domino's franchise in India, would expand its network of outlets by 1,300 more, bringing the total number of locations to 3,000. Currently, the corporation operates 1,701 Domino's locations in 371 cities. Domino's recently announced the formal launch of its 20-minute pizza delivery in India, making it the first market globally. The quick delivery promise, which Domino's has been working to perfect for some time, has so far been implemented in 20 zones spread over 14 cities. As a result, the business will now need to expand its retail network and make sure that its hot pizzas reach customers on schedule. The relocation is being driven by enhancing and optimizing in-store process improvements, technology advancements, interventions for greater operational efficiencies, and expanding stores nearby. According to Domino's executives, quick delivery of pizzas will enhance customer retention, order frequency, and sales volumes dramatically, which will also reduce labor costs. While this expansion presents endless opportunities for the future of the company globally, let's dig into the numbers to see if this stock is worth every penny. Domino's revenue for the past 10 years has averaged $3 billion from $2 billion in 2012 to $4 billion in 2021. Talk about a 100% increase in revenue in just a decade. Its operating margin has averaged 17.7% from 16.8% in 2012 to 17.9% in 2021. Our favorite part is how it fared in its return on invested capital. In 2012 alone, Domino's has returned 48.2% in 2012, and this went up to 66.2% in 2021. That's an average of 63.8% in just over a decade. Even the S&P 500's average ROIC was just 10.2% in the second quarter of 2022. Domino's has surely outperformed the general market in many segments. At its present share price of $323 a share and conservative earnings per share predictions of 12% annually, our model projects that Domino's stock will have annual returns of 13.9% over the next 5 years. So there you have it, folks. Those are our 5 top stocks to buy right now. Comment down below your favorite stock pick, and if you enjoyed our content, don't forget to hit the like and subscribe buttons, and we hope you have a truly amazing rest of your day.